Good morning, everybody. It's 11 o'clock, so we're going to get on with things, I think. Our guest this week is Luciano Suana from Manhattan. And before we get to talk to him, I'll be running through a bit of news. There's not really an awful lot that happened this week, to be honest. I want to look at Aberdeen New Indy just because I'm going to be seeing the manager next week, I think, so I'll probably write something a bit more detailed. But I was really surprised to see how well it's doing at the moment relative to everything else. Um, so here is the chart, and it's a nice sort of start in this corner and go up that way. So it's obviously been performing quite well, but the discount is stubbornly wide, so still about 18%, and it is a decent size. Here it is in the context of the rest of the India sector. So you can see that that discount is a little bit narrower than JP Morgan's. The top one on here is Ashoka, and that is reflective really of the performance that Ashoka's been delivering. So that's well ahead of everybody else over the sort of longer term. But more recently, just over a year, Aberdeen is now the sort of current pack leader. And that's quite strange because it was for a long time India Capital Growth. So I would sort of thought, let's have a dig around into this and find out why. Here you can see that the mid-cap stuff that the India Capital Growth Fund has been focused on has been outperforming, and the MSCI India, which is more like the Aberdeen and JP Morgan portfolios, has lagged it a bit. Obviously, they're still doing quite well. And here are Aberdeen New India's returns, sort of broken down cumulatively. Decent positive absolute numbers, but relative, it had a really quite disappointing period here between about sort of 2020 and 2023, mid 2023. And it's only recently that it sort of picked up a bit. So even though it's done very well, it's only just managed to beat the MSCI India over the last sort of 12 months. Now, this is the interesting chart because this is what sort of foxed me really, because you can see that everything was sort of moving quite predictably until we get to about here. And then these are relative charts. So MSCI relative to its benchmark had a little dip down and then shot up, and it's been outperforming. The India Capital Growth Fund fell off a cliff and is still falling. Obviously not great, and that's relative to the S&P, BSE midcap. Now that sell-off in mid-caps was triggered by regulatory investigations into a whole bunch of different things, but it seems that India Capital Growth has ended up caught with some of these more speculative stocks that where the prices were too high, and they've been hit quite hard by this. And then we had the dislocation from the election, so that ran on for quite a long time, and the result wasn't quite what people were expecting, so that caused a bit of instability in the market too. So there's initial kind of like market fall. Then people said actually it's probably going to be sort of business as usual. So it sort of bounced a bit. In terms of what the new India managers are saying is that they think that the sort of basic reform stuff that's been going on, put money into infrastructure, support manufacturing, support technology, that's going to carry on going. But they don't expect to see any more really radical change, the sort of things that Modi did when he introduced that sort of VAT type thing, for example. But the reason they probably lost the election, partly it's rising income inequality, which is true the world over, but in India particularly, it's because there's rising unemployment among the youth, and also particularly in rural areas. So they probably need to sort that out, which is being a bit more sort of populist. So expect that sort of stuff to continue. Actually, what we're talking about is the government supporting the continued growth of the economy, and it's the fact that India is growing so much faster than anything else that's sort of been driving this. India is expensive too. So here we look at it relative to China, rest of emerging, which is obviously heavily influenced by those two things. So India is now the second biggest component of the MSCI Emerging Markets Index. So China's about 27%, India's about 18%. And that's obviously a chunk of the world index, which is dominated by the US. I mean, those stocks in the US are expensive too. But nevertheless, India, it really is looking quite dear. So these companies that are in there need to carry on generating the above normal growth that they have been doing to justify those kind of ratings, and that's what's going to make the market more volatile going forward, I think. So it did announce results this morning, and that's obviously what triggered this. And in the period that we're looking at, it actually lagged the index. So that sort of shift to outperforming has only really happened in April and a bit of May since. Sorry, yeah, and the discount didn't really move, even though they bought back a lot of shares. And so I think they've got a big job to do in terms of trying to convince investors that they want to back this thing. But I do think that India is quite an important market now because of what we've been saying. Because it's growing so much faster than China, because it's increasingly important within the emerging markets, I think it is going to be somewhere to focus on. They have rejigged things a bit, so they've changed the structure, the management structure a bit. So Christy Fong's stepping down, James Thomas now lead manager, he's got a new assistant. They're putting a bit more kind of mid-cap focus into the portfolio because it's just a bit too much like the benchmark. So they're making it a bit more active relative to the index. And they're also going to be able to put up to 10% of pre-IPO investments because there have been quite a lot of things coming to the market. And again, this is what another area of volatility and one of the things that Indicator Growth was doing quite well out of, and then it's fallen back since. So whether it actually takes advantage of these things, we'll just have to wait and see. But they do have to get on with things. If they don't, there's this conditional tender offer coming. So they sort of guaranteed to probably lose a quarter of the fund if they carry on underperforming. It's measured over a 5-year period that doesn't end until March 27. It's based on the NAV adjusted for the capital gains tax, because obviously you can't actually quite track the index as any kind of manager because there's capital gains involved. But they have got a bit of a catch up to do. So 2 years into this measurement thing, they are 5.7% percentage points behind the target. So they do need to do something about this. So I do think this is an interesting fund, and that 18% discount is too wide if it carries on doing relatively well compared to everything else. Last, just very quickly on Asia Engine Impact, because it is really the last day of it existing. There's a vote today. It's almost certainly going to be liquidated. Just if you are an investor in this, it's obviously trading on a massive discount, about 20 cents per share. The NAV is now only 45.6. It looks like they've got enough cash to pay an 11.4 cent distribution by the end of July. So a big chunk of what the current share price is going to come back in cash. But then the next chunk won't really come until they've sold the rest of the portfolio. And they say that the process is well advanced, but obviously that doesn't mean anything really. So anything might happen. So you could be waiting a few more months for more, but we'll just have to wait and see. The thing that crashed the fund and the thing that caused all the problem is this solar project, ROMS. So they had to put another $4.5 million into that to keep the whole thing going. Otherwise, they were going to trigger some penalty things that would have taken out another big chunk of the NAV. So they've done that. It should be operational by the end of the month, but as there's always these things, if something goes wrong, everything goes wrong. There's stuff that the landlord's got to do for the big site, and that hasn't been done yet. So that's almost certainly going to be delayed. And how long it's going to be delayed, I don't know, but it could be some time by the looks of that. And so it's probably going to need some more cash. They're saying about another $1.2 million. That 1.2 million, they've already got that because the cash that they've got is a lot more than that 20 million. So I think it's about 33, and they're holding back a chunk of it to cover the expenses of the fund going forward and this. So that's what's holding that up. So it will get wound up, but you're not going to get your money back in a hurry. So that's enough from me.